right? So Bitcoin miners can go do waste power because, that's what they need. They can't, and they're willing to turn off. Whereas the AI centers need base load, need consistency, needs redundancy.
When you arrived this morning, we had a conversation. I said to you, Rob, so how was the drive over in the Tesla? And he says, what did you say to me? It drove me here nicely. I'm like, oh boy, that's a shocking thing. They didn't even think of that 10 years ago. We didn't even barely had iPhones 10 years ago. So to me, it's this electrification of the whole global grid massively happening in China. 50% of all sales now are the plug-in hybrids. Mine plug-in hybrids, 11 years old. My Chevy Volt. It's a wonderful vehicle. So to me, that's the key thing that's happening. Everything I hear and see is bad for petroleum prices.
There is a reason why nuclear reactors and power plants in general are big, because you have a fixed cost. Whether I'm building 5 megawatts or 5 gigawatts, my fixed cost for my lawyers, my lobbyists, the activation of teams to get this thing supported, the modeling efforts, it's the same. Whether it's 5 megawatts, 5 gigawatts. That's why you build big.
In countries and in markets that have embraced the energy transition, so you've got more solar, you've got more wind, you got more things like that, he points out that they often have higher electricity prices. So I'm curious, is the explanation for why California's electricity or why the UK's electricity is so expensive, would you place the blame on renewables? And do you believe the basic LCOE calculus?
I'll go back to capital allocation. Poor capital allocation leads to poor results. So Germany, California, they were basically forcing a non-market natural result. So they were forcing maybe like a 12 to 15-year break even onto people. And people's WACs don't want to do that. And weighted average capital costs. And so people, and then you had the mismanagement of the utility too, right? So the utility was also incentivized and said, you should allocate. We go back to our utility discussion. What is the goal of the utility? It's not to pick the most expensive. It's not to pick the least expensive. It's to create a portfolio of robustness, least regret option. That was like a theme that we had at AP. And
okay, it looks like we've got a quorum. We're trying something new today, so hopefully we're not going to have too many technical snafus, though it is possible. We're in an office in our lovely office in Miami today, and we have a special guest. So our special guest is David Bellman, who works at SynMax. And I'm gonna just pivot my camera here. So David is sitting here next to me, who's sitting next to Mike McGlone. So we're actually all in the room together, and hopefully we're gonna be able to make Zoom cooperate with each of us being on camera when we speak. Okay, so I've known David for 25 plus years. When I was a very young junior analyst, I started off my career doing coal and emissions modeling, and I believe he's working at AEP at the time, and he was a critic of what I often would put out, but I always appreciated his feedback, and it's been delightful that he's kind of followed along with much of my career in various ways, and always been there to help keep me in check, make sure that my ideas are better grounded. And sitting next to David, we've got Mike McGlone, who I think you all know well. And so today we're going to have a different kind of conversation. So one is, first of all, David works for a company called SynMax, which is a kind of geospatial company. They use satellite data to do some interesting things with energy. So hopefully we're going to have a chance to talk about that a little bit. But I think broadly, let's kick off the conversation with the discussion about what are the most interesting segments of the energy market today, right? So we saw the news from DeepSeek over the weekend really cause some change in thinking, some revaluation, particularly on some of the names geared to the AI theme. Vistra, GE, Vernova, on down the line, they moved quite a bit off of the news for that. And so kind of, David, I know you've got a big picture perspective, whether it's gas, power, renewables, kind of cross spectrum, where do you think of as the most interesting spaces within the energy landscape to be in as an investor right now?
Well, what I find very interesting in this period of time. So you and I had a career, spanning 3 decades. And if you look at the executive levels at most utility companies, they never saw this load growth. I think that's the key thing here. We are in a new paradigm of load growth in this country. Over the last couple decades, what you saw was a huge energy efficiency gain in both the generation space, from moving to combined cycles to LED lighting. So those things actually caused flat to no load growth. And then, of course, you saw some exodus of industrial manufacturing. Here we have a different story, and I don't think most people have the experience of this story that are currently working in the field, right? They don't have the experience of this large load growth and how do you manage this load growth. And so I think that becomes the pivotal issue as we move forward.
Mike, I want to get your response as well. What do you make about the construct of load growth, and how do you think about this world in which we live? Is AI, U.S. manufacturing, other things like that going to drive an acceleration in kind of demand for power in all forms of energy in the U.S.? And how do you position looking at the commodity market, depending on how you think that thesis unfolds?
I think the key theme, certainly from you and David, is that when you arrived this morning, we had a conversation. I said to you, Rob, so how was the drive over in the Tesla? And he says, what did you say to me? It drove me here nicely. I'm like, oh boy, that's a shocking thing. They didn't even think of that 10 years ago. We barely had iPhones 10 years ago. So to me, it's this electrification of the whole global grid massively happening in China. 50% of all sales now are the plug-in hybrids. Mine plug-in hybrids, 11 years old, my Chevy Volt. It's a wonderful vehicle. So to me, that's the key thing that's happening. Everything I hear and see is bad for petroleum prices, particularly from our US president. And all the trends are in his favor. So as a commodity strategist, I look away. It's harder for me to measure power prices and things. But from a petroleum price standpoint, we use less of it and we need less of it every day. So I still think what's going to happen, our next big trade in terms of what I really look at is, first of all, we look at natural gas. It peaked this year just above 4. The lessons of natural gas for a decade have been when it goes above 4 and managed money net position specs are long, you get short. I think it goes back down to 2. It's a trade. Maybe it can stay above 4 if it's enough demand pull, but every time it pops above 4, we find more supply, and particularly have a president who's quite motivated. Look at crude oil. Peak this year so far, WTI at 80. I think it's peaked. I think it's going to 60. Not only do we have a president behind it, we have all the trends in favor of it to going lower. The major trends. People point out the little things. The big things are, right now, this year, the U.S. is on pace to export about 4 million gallons a day of crude oil and liquid fuel. Net exports, we have to export. It's becoming a bottleneck. To put that in context, in 2019, when the average price of crude oil was 57, we were net importers. At the same time, you look at OPEC spare capacity. Right now, it's like 6.5 million barrels. In 2019, it was closer to 5. China demand, around 11 million barrels a day. I mean, imports, about the same as 4 years ago, and declining. So everything I see for crude oils is going to do what it has done since 2007, and that is bottom around 40. That makes Trump happy. That makes interest rates lower, makes him happy. And guess what? It also pushes back on Russia's ability to wage war. So to me, this is where we are. I'll be wrong if we can sustain above 80 WTI. So I'd put that as my stop as the next trader. And I think it's just a matter of time we print 60 in the front contract. But overall, it's the energy transmogrification. It's the demand for AI and all that. But I'll end with this. The lessons of Jeff Booth, the price of tomorrow, how superabundance and deflation is a major force, particularly in your space. Yes, we're going to use more lectures for AI, but we can find more of it easy every day. And what did we just find out recently from China? When you have companies in tech making a lot of money, they're radar for competition.
David, I want to get your feedback on the natural gas view that Mike just espoused. I know you've long held views on the gas market, and what's your fundamental read? What's the long run equilibrium or the medium run equilibrium price of natural gas in America?
All right. Well, first of all, Mike brought up oil, and so my beginning of my career was oil, right? So I was very fortunate to graduate, chemical engineer, and I was hired immediately. First one ever hired in a 50-year history at Purvin and Gertz. And so I started in oil and gas refining oil. What was funny during that time is to forecast crude oil higher than $30, you would be, basically considered crazy. All right. So this is in less than 3 decades, guys. We're now, it could touch 60. Literally, you couldn't forecast higher than $30 back then. So OPEC really is and has managed the market, and they have basically essentially subsidized U.S. producers. That's what they've done. And the question is, how long do they want to do that, right? There is a connection between oil and natural gas, obviously. With the production of oil, you get natural gas. When the U.S. was not exporting LNG, basically gas could crash and oil could continue to do whatever it does, right? Because natural gas became a byproduct. Now it's the equation for natural gas is a lot more complicated, right? Because at least for the U.S. market, because now you have 15 BCF a day of LNG exports and growing potential. And that changes the dynamic of, okay, well, I can't just forecast natural gas as a byproduct and it could just go back to your $2, right? And cycle back to $4, $2, cycle back to $4. If you allow exports, which we do now, of a significant volume, you now have a global studies that you have to do. So when I was doing fundamentals for oil, it was a massive undertaking. I had a supply demand model, every single country, and had to deal with all this dynamics plus politics. Natural gas, it was a much easier problem back then, right? It's domestic market. You just kind of calculate your demand, you calculate your supply, and there it was. But now, with 15 BCF a day and growing, I mean, now you have to do a geopolitical analysis. You have to do a country analysis. You have to expect is fertilizer growth is going to happen in, XYZ country. And so I don't know. My hypothesis would be, I think the range of natural gas is likely to be higher and higher to the upside only because you have a global dynamic now.
Can I just mute my mic? Dave, I want to ask you one thing about that. Is the key thing I understand about U.S. natural gas is the U.S. exports about 20% of it, 10% is LNG. So maybe that goes to 12 or 13% in the next 4 years, maybe 15%. And every time I've learned that lesson, every time prices go up, when people tell me what you just did, we always bring on more supply. It's from a farming background I have. There's massive supply of soybeans out of Brazil, well, because prices went up. There's massive, that's an elastic sector. In energy, I see the same thing. Everybody who told me that the U.S. peaked shale, right around the Russians' invasion of Ukraine, missed the key thing, incentive price. And then technology. So here's a question I want to ask you is, every time it goes up to 4, we bring in more supply, and I've been proven wrong. So I just go with what works. And here's a key thing, short-term, managed money net positions futures are way long. I mean, the longest right now in 4 years, since 2023. So I look at that as a trader. Okay, you might be thinking bigger picture. I look at shorter term, sell 4. You look at the March contract now, it's 313. The February contract printed 430 or so. Maybe prints a 2 handle and you cover that. But those positions are way long. Crude oil is way long. Corn's way long. So short term, it's what worries me. And then it's the macro. Here's one it might not be used to is the entire state of New York City has not opened up to natural gas drilling yet. A little bit of oomph from Mr. Trump and an energy emergency we declared. There's massive supply there too. But even without that, lessons I've learned is it doesn't go above 4 unless there's an invasion in Russia and Ukraine. And what did that do? It went to 10 and we pushed it back down to 1.5 a year later.
Yeah, I don't think we're saying anything different. It's just the context, right? So absolutely, I think on a macro basis, you will always go back to your marginal cost of economics. But what we have here is potential of dislocations and rapid dislocations. I think DeepSeek was a perfect proof of rapid dislocation. I think it's funny to realize that Vistra drops about 30% in one day, and everyone thinks that Bitcoin is volatile. We have a utility stock dropping 30% in one day. So anyway, so like I said, I think we are saying the same thing, just in a different tone. Is that I think that in the long term, you will approach marginal economics. And marginal economics, and this is the game theory of efficiency of and the value of greed, right? You try to find ways to make money, and you look at your cost structure and you drive to that, right? And you get profit from that. So in the near terms, you will have a lot more dislocations because you have a lot more distribution of where you can take your product. Once again, I'm talking natural gas, whereas before you didn't. So you can just kind of waddle through and suffer. Now you have options, and then you have demands that can come that wasn't there before, right? Ukraine is a perfect example of volatility. If you think about it, we recovered relatively fast in terms of price from Ukraine. I mean, I remember moments. In fact, I was working on trying to move coal from the U.S. to Europe at that time, and these are the fun things that you get to do when you work with someone like Bill Perkins. And I mean, who would have thought that coal prices north of $200 a ton? And, I mean, things happen, but then all of a sudden now it's back to like coal's nothing.
Yeah.
Okay, David, I want to probe a little bit more. You just mentioned Bitcoin, crypto. So a big theme in, I think, energy markets is that the AI revolution, the crypto revolution, is somewhat constrained by energy. I don't know if that's really true or not, but I'm curious to hear whether you think that is true. And you mentioned the response of Vistra. How do you read this new DeepSeek announcement? How does it play into the AI narrative? Does it have any read across into crypto? What is the nexus of energy and AI crypto in your mind?
Yeah, so let's define crypto a little more discreetly so I can have a better discussion, because meme coins, NFTs kind of cloud the situation. So let's just say Bitcoin for right now, right? Let's just keep the discussion a focus on Bitcoin. So this is a continuing theme that I've had, is that this convergence of power from compute, electrification, EVs, everything is coming to power. And so what was interesting over the last 5 years or so was the Bitcoin evolution. And so I spent a lot of time there. Once again, fortunate to work with Bill, and we looked into Bitcoin mining. I also was able to work at a really great innovative company, BitUda, in Connecticut, and we were looking at Bitcoin mining there, and I've done a lot of analysis in that space. So you have this surge of power demand to create what they call as a Bitcoin through mining. And then this was at a time when power was actually with no demand. So it was actually becoming the savior of the market at this time. And we can talk about the merits of Bitcoin. That's a whole another discussion, but I'm just trying to stay on the energy portion of it. And so then you have the AI revolution come forward. And what's interesting is these two loads are completely different. All right. So most people don't understand this part. This is very important to understand. So Bitcoin mining requires relatively cost-effective power prices in order to be profitable. So I'm going to throw out the range for you. So depending on the situation, depending on the mining, depending on your fuels, depending on the location, the range can be between $40 to, let's say, $190. That's roughly the breaking with the average being around $70, $80. So if you don't have power prices south of that number, you're likely turning off. Okay. If we look at an AI facility, a data facility, and anyone can do this calculation, you can look at Amazon's website and look at how much they want to charge for 1 hour compute of a processor, right? So they're charging, I think, $5 an hour as an example for H100. You can back reverse engineer that, like what's $5 an hour, what's the power effect, how much does the H100 take, consume, and you're well north of $3,000 a megawatt hour. So you have a load here of Bitcoin mining who's willing to help the market turn off. It's not altruistic. They're turning off because they're not going to make any money. And then you have an AI center that's not going to turn off. Their marginal cost is so high that your utility cost likely is lower than theirs.
Yeah.
So that's where the intersection is going. That's where the debate is going. But they're really trying to capture two different loads, right? So Bitcoin miners can go do waste power because, that's what they need. They can't, and they're willing to turn off. Whereas the AI centers need base load, need consistency, needs redundancy.
Well,
Mike, I think you've got a comment to add on the nexus of energy and cryptocurrency.
Well, I like your in the weeds background. Obviously, you know a lot about it. I like to look at the macro. We have a president now who completely, part of the reason he got elected is because he went from an antagonist to a zealot for cryptos. Hey, if I make the price go up, you might get elected and okay, we'll give you money. Everything worked. There's a lot of nuances behind it, but now there's a complete vested interest in the price of this highly speculative digital asset to go higher. Now, I've been very bullish Bitcoin most of my career here, except 2017. It was just silly, stupid. Now, it used to be number go up technology. Now number has to go up or else. So I love to compare it to crude oil. There's a commodity that has to go down if Trump's right. I mean, this is all that matters now, I think, in main ways, because this is kind of what produced cryptos to new highs, the election of this of Mr. Trump. So I like to look at it. It basically takes right now about 1,400 barrels WTI for one Bitcoin. That has to go higher. To me, it's an X option trader, next trader. Like, okay, that's priced in. It's got to go higher. The optionality, the trade is if it doesn't. And it's all about one thing. Bitcoin has to stay above $100,000. It absolutely has to. Because look at the iterations. If it drops, that's a negative indication for all risk assets. The highest correlation right now to the stock market ever is Bitcoin, 100-day basis. There is now, the problem is, whenever I really got bullish Bitcoin years ago, I used to point out in coinmarketcap.com, there was couple thousand listed. It got out to be 10,000. Now there's 10 million cryptocurrencies listed on CoinMarketCap. I mean, guess what? Everyone's better than Bitcoin. At least they say they are. That's the problem in this space. You just look at one of the top 8, Dogecoin. It's worth $50 billion. That's more than BNY Mellon. And BNY Mellon makes 19, basically this year is supposed to make $19 billion gross. Just silly, massive speculation. And I think we're going to look back from the future and say this whole space is just silly expensive. We could lop off a zero of those 10 million cryptos, and they're still too expensive historically. Right now, they just have momentum. They have FOMO. They have everything going in their favor. So the way I look at this is crude oil is more likely to drop towards 50 or lower this year, potentially soon. I've been wrong on that one, but it's been a little while. We've had major issues. Trump's going to get what he wants. I'm going to publish on that tomorrow. And Bitcoin has to go higher, which means the risk goes down. So I'll end with this. I had a good, very successful money manager I spoke to yesterday. We've been talking about Bitcoin for almost 10 years, and he's been spot on because, Mike, I've just been buying Bitcoin for my clients. And I'm like, I think it's going 100,000, 170,000. I said, what do you think that means for the stock market? He says, why? Well, that means the stock market's going to have to be up about 20%, unless things are going to change. It's very highly correlated asset. It's 3 times the volatility of the stock market. So my thought is the risk is it goes down to 70 and everything follows. But we're already priced for it to go higher. It's completely expected. We all know about human nature is what we generally anticipate doesn't happen.
Okay, I have to respond.
I figured that would fire you.
Yeah. I'll try to be really nice about it.
No, come on. Let's have some disagreement.
All your basis is, and I like the facts, I like the numbers, it's based on history. I think that we are at an inflection point, so that's where we're different. So I spent a lot, I wrote a paper on Bitcoin, particularly focusing on adoption rate. So there's some numbers out there. I think we're between the 1% to 3%. Some people have even calculated up at 5%. If you look at various technologies from emails, internet, cell phones, that 1% is a crucial number for adoption rate.
Adoption for what?
Okay, so
Investments? An investment portfolio?
no, for people's use of a product, right? Cell phones, as an example,
Yeah,
emails.
yeah.
So people's use of Bitcoin, for better or for worse, using it to store their value, whether they should or not, that's a different point. But I'm likely just trying to tell you that you need technology needs to hit above 1%, and then it changes the trajectory of the product. So if you look at product failures, like if products can't get to that number, they fail.
Right.
So here you have a product, Bitcoin, which, you know, now has, and if you look at other products, they took this long too, right? It takes decades to reach 1%. 1% is a big number. It was 6 billion people. Okay. And so when you do your analysis, you say, oh, it's correlated to this, it's correlated to that. Your correlations are all based on history, and it's history of a different paradigm. So maybe it's not different this time, right? That's the word that everyone's concerned about when they're forecasting, and they say, oh, it's different this time. You can only say it's different this time if it truly is different this time. And I would say, just based on this metric of adoption rate, that's what causes it to be different this time. And maybe I'm wrong, and that could be the case, but at least I have something to point to. I'm not just like saying, oh, it's different this time, which is a common cause of bad forecasting. But that's why I spend a lot of time understanding the adoption rate of the various technologies.
Well, there's no risk in predicting the future, which is our jobs. And we can only base it on what we and extrapolate into the future. And that's like to point out, okay, well, Bitcoin versus 10 million other ones. Yeah, I just think that I've just never seen a space where there's unlimited supply, ease of entry, massive excess of speculation, and people are jumping on board. I've just heard this in history. I've seen it before. Just sorry, not for me, but it's when people hated it is when I got bullish. And now when everybody loves it, I just have to, it's a curse of being a commodity trader. I'm a contrarian by nature. So,
so a commodity trader I am, and fundamentally I'm a fundamentalist, right? I look at supply and demand.
Yeah.
So it is a false statement to say there's unlimited supply. I agree on the non-Bitcoins, right? But the non-Bitcoin speculation is collectors, right? That's like Beanie Babies, and that's more analogous to tulips, right? Tulips, Beanie Babies, etc. Bitcoin is something that has utility and has focus. Its focus is, I have a ledger system, I have no intermediaries, you can move money from point A to point B, you have security, you have 15 gigawatts of worldwide security, essentially free, not really free, but it's part of the ecosystem. And you don't need these intermediaries to move money. That's the utility of it. And you can fractionate it. So there is utility, and now there's adoption. You can't, if you have utility and no adoption, it doesn't work. If you have utility and adoption, which now you have institutions involved, you have ETFs, it's legitimized it, and it's changed the paradigm. That's the concept.
Hey guys, I'm gonna draw us back to energy. You guys, I feel like half our crowd probably was like following, but maybe a bit disconnected for the group here. So, you know, not to we'll table the crypto theses for now, but I'm curious. So my sense is, okay, we have fundamental demand drivers for energy driven by various trends, including crypto. And I'm curious to get your read, David, and this is perhaps where you can use your SynMax hat a little bit. What kind of power plants are easiest to build? You mentioned that data center customers are very price inelastic. It sounds like, you know, they'll pay a lot of money for power, they put electrons. So which electrons are easiest to get on the grid? Where are companies actually trying to build power plants right now? Is it all in ERCOT? Are there other places? And, you know, what's the fastest timeline for getting any kind of power plant online in your mind? So you're a highly motivated hyperscaler. You want to have a reliable data center. Where do you build it, and what kind of electron supplies that data center?
All right, great question. And I did not bring up crypto, you did. But so let's set the stage here. Here's the stage. The EIA releases the amount of proposed plants in a file called the EIA 860M. The 860M every month shows, you know, all these projected plants. What is amazing is in 2025, they have, anybody can guess how much they have for this year's build? Over 62 gigawatts. The last time 62 gigawatts was built in this country was when?
I don't think ever, but is 62, it's got to be all solar, right? Like it's not, it can't be much else. It's like 90% solar?
No, it's like 60, 70%. And then wind, batteries. So the last time it was built was 2002. So in 2002, that was the combined cycle renaissance. And so you saw this huge amount of builds. Let me connect some more dots. So I've been building power models. I've been running dispatch models. I've built a trading platform based on model simulations. And a very important part of your inputs is obviously fuel price, load, and then the most important, one of the most important is the generation stack. And so you have this 62 gigawatts being proposed. How many of those 62 gigawatts are real, right? And so that came to me and inspired me at SynMax to create a product called Vulcan UC. So Vulcan UC, what we do now is we take satellite photos every single week of all these power plant projects. And we're trying to understand is, number one, is it under construction? Because if it's under construction, then you have some skin in the game, right? You just didn't file paperwork, right? There's two dates that we monitor and capture for our clients. One date is land clear. So, you know, land clear is some skin in the game, but it's not really that much skin in the game. And we see a lot of delays in some projects before the next date that we capture for our clients, which is the first structure. So now you have, if it's under construction, when it land cleared and when it built its first structure. From there, we can estimate at the very least, and it's not really estimate, it is by fact, we can say what's the earliest it can come online. What's the latest can come online? It could be very late, but what's the earliest it can come online is very factual, right? We can look back, and this goes to your question, what is the fastest to get built? So we look back at projects over the last 5 years and said, okay, what is the fastest timeline to get something from under construction stage to finished? Whether it came online is kind of a more gray area, right? Because sometimes you get delayed for testing and other things. But in that window of space, the fastest project we found was a solar battery project at 210 days. Yeah. That's the fastest. So if you need speed, you can build a solar and battery plant 210 days. Now, You look at AI data center, you look at that load profile, they don't connect. Right. So what are you going to do? You can look at a gas facility, but gas facilities do take a long time. It may be a brownfield. You can probably maybe do a brownfield like an add-on, maybe in 24 months. So if you want speed, and this, you bring up politics quite often, Mike. So I'll bring up the Trump thing. If you're anti-solar, anti-wind, but you need load and you need generation, you may have to go ahead and turn to battery, solar, wind, because they are just faster.
Yeah.
Well, part of that is for me. I bring up. I've heard people. I bring whatever I think is the absolute most relevant all the time, every time for whatever things for markets are going. And right now you cannot ignore. And to me, it's just most important to focus on what Mr. Trump's doing. But key question I want to ask you is so. For that is don't if you're putting in solar, I'm a big fan of residential solar because to me it's every structure on the planet can it can do that. I did it in my home in Connecticut. It worked great. And that was 15 years ago. But the key question I have for you is when you do that, do you have to add like natural gas backup too for the down point? And obviously you can't store as much as you want all the time. And then there's winter. And I mean, how do you adjust for that?
Well, luckily for us, battery prices are coming down. So I gave a speech maybe a year ago at a conference, and I basically said, look, batteries is your new solar. And what do I mean by that? If you look at the forecast for how much solar would cost, it's been consistently wrong for the last decade. Like it's always been lower. And I think we're into that paradigm where the battery costs will always be lower than what you expect. And, it started off with, once again, you have to thank Elon, right? With electrification, that focus on the battery supply chain. He developed this for us, if you think about it. And then all of a sudden, now you saw mass power, power uses. And so now you see, megawatts of batteries coming on. And the supply chain is really, really, really hard to compete against. So if you look at other technology, so I go to a lot of technology workshops with a lot of PhD people thinking about all the other ways to create storage. The problem every time they have this idea, and science-wise it looks great, it's like, how are they going to be able to scale up to catch up to the lithium-ion battery supply chain? It's almost impossible task now.
Okay, so we're running over a little bit, but for anyone who's still listening, we'll keep going for a few more minutes here. So I'm curious, given the setup you just described, David, do we look at GE Vernova, Siemens Energy? I think they've got backlogs on delivering gas turbines, right? But you just described a world that was quite optimistic on solar plus storage, maybe renewables plus storage. So are we entering a world, do we really need all the gas turbines that are in the queue to come if we are going to see this sort of utopian future of cheap batteries that get cheaper every year, perhaps paired with solar, which is also getting cheaper every year?
So most people don't know this fact. Last year, 2024 was the first year that no combined cycle was built in this country, going decades back. I mean, even at $8 MMBTU periods, they still had combined cycles being built. So it just shows administrations and policies do have impact. I mean, so I think we're playing catch up, really. I think we'll always need continued building of, if you believe in load growth, you will always have continued building of base load growth. And it's always good to have diversification, portfolio, risk analysis. I mean, the job of a utility ultimately is to supply reliable power at a cost-effective level, not the cheapest level. That's where a lot of people misunderstand that. So as I was a managing director of strategic planning at AP. So we had to find the solution that wasn't the least cost, but wasn't the most cost, but was cost effective, reliable, strong, and diversification is inevitable in that sense. And so you need that natural gas. It's going to continue to get built.
Maybe just to throw another grenade in your direction, a number of the AI companies have been investing in restarting existing nuclear facilities or partnering with utilities to do that. And many have contracted to do things like SMRs. So what's your sense on kind of advanced nuclear, existing nuclear? How does it fit into the equation in your perspective?
So this is the pessimist in me. I'm generally optimistic, but regulatory experiences have just bashed me down on this, and I just don't see. I just don't see it happening in a big scale, and there's a fundamental issue with the small nuclear reactors. The word small. There is a reason why nuclear reactors and power plants in general are big, because you have a fixed cost. Whether I'm building 5 megawatts or 5 gigawatts, my fixed cost for my lawyers, my lobbyists, the activation of teams to get this thing supported, the modeling efforts, it's the same. Whether it's 5 megawatts, 5 gigawatts. That's why you build big. Right? I mean, I don't know how you avoid that.
Well, can I interject one thing here? The most notable thing I noticed, having done this, installed solar in my house, is no moving parts, instant electricity. Just takes my electricity bill, cut it 70%. And it can last 30 years, and you can depreciate it in 30 years. You get much better technology. To me, that's the key thing. I always think, yeah, hydrogen is great, but it's still difficult. You got to transport it. And I look at all this technology is rapidly. Why are we getting massive supply of crude oil in this country? Is because of drilling technology, basically. What does that mean? Geothermal. So I look at decentralized energy production in an individual home. Is the technology is only going anywhere, nowhere. That's why I look at solar. There's just no moving parts. Turbines, that's a moving part. It's going to break, and you have to fuel it. But what stops that technology? And then the key thing, I look at it from China, massive deflationary forces from anything renewable. And that's why I thought DeepSeek kicked in. It's like, this is all predicted. Expect deflation continue out of China.
100% agree with you on the solar story. I think Rob and I have talked about this multiple times. I think, once again, adoption rate is important here for solar. What you're seeing, and this is just natural utility, your utility rates are rising even when gas prices are sub $3. Why is that happening?
Everything, right?
Well, the business of utilities.
Yeah.
Please ask yourself, how does this utility distribute a dividend? Think about that. Through investments. How are they investing? When you allocate capital poorly, you get long-term bad results. So utility rates are rising across this country. You have a falling solar world, right? Solar costs continue to fall down. The biggest cost now of solar at residential level is your labor.
Yeah.
So when that guy shows up at your house, you're going to overbuild. Why? Because the incremental panel is zero, essentially. So you'll overbuild your panel at your home. And when do you build this panel at your home? Utility rates are rising, solar costs are coming down. There is going to be an inflection point where it was a 9-10 year return on investment. I believe when it drops below 5-year return on investment, you're going to get massive adoption rates.
What stops that? Just a matter of time.
Well, that's a pretty pleasant place to perhaps end. Maybe I'm curious then. So, but final question will just be on the thesis that you've laid out. There are some strong contrarians to it. Bjorn Lomborg, or the environmentalist who often likes to point out that in countries and in markets that have embraced the energy transition. So you've got more solar, you've got more wind, you got more things like that. He points out that they often have higher electricity prices. So I'm curious, is the explanation for why California's electricity or why the UK's electricity is so expensive, would you place the blame on renewables? And do you believe the basic LCOE calculus that, you know, solar electrons, wind electrons are really the cheapest? And I think you just sort of described why rates might be changing, even though you would be putting cheap electrons on, but help frame this idea of, if you have rate escalation, what's causing it, if it's, and how do renewables fit into that? Because I'm curious to hear your thoughts.
Yeah, it's a really good question. So I'll go back to capital allocation. Poor capital allocation leads to poor results. So Germany, California, they were basically forcing a non-market natural result. So they were forcing maybe like a 12 to 15-year break even onto people. And people's WACs don't want to do that. And weighted average capital costs. And so people, and then you had the mismanagement of the utility too, right? So the utility was also incentivized and said, you should allocate. We go back to our utility discussion. What is the goal of the utility? It's not to pick the most expensive. It's not to pick the least expensive. It's to create a portfolio of robustness, least regret option. That was like a theme that we had at AP. And I don't think they picked the least regret option, because they probably are regretting some of the cost structures they have. I mean, it's crazy to see that San Diego power is at $500 a megawatt hour for a consumer level. I mean, it's amazing, right? To get to that level. And so that's, do you blame it on renewables? You can't really. I mean, at some level, they also are creating this fall, right? Because you had to have a force of manufacturing. You had to do so. I mean, I guess altruistically, maybe they could feel good about themselves because they started this revolution, right? And now it's snowballed. It's going down the hill. As Mike pointed out, it's getting cheaper and cheaper. It's a snowball now.
So I said last question, but I'm going to ask one more. We're seeing really big build out, record projects in places like the Middle East for building giant solar farms with battery storage, things like that. This is starting to be a theme that's not just in US, Europe, and China. It's spreading all over the world. So would you what would you advise people and say, like, Saudi Arabia or UAE, who are sort of more early in their journey into the energy transition and renewables, how do they avoid the pitfalls of what you described there in San Diego?
Well, I think you have to remove politics, you have to remove biases, and just do on economic fundamentalist, higher fundamentalist, right? To really, and LCOE is a dangerous calculator. Okay, just be careful of I actually wrote a paper on this too. LCOE has misled so many people, because it's really, as any modeling is, it's what you put into the inputs. So.
Yeah, I also think of LCOE as a very useful tool, and perhaps the least bad amongst your options for thinking about power markets, or sort of type of capacity that you'd be adding to a power market, but a lot of pitfalls. And I like your sort of reckoning around a portfolio approach that you described, because I think folks do want reliability and other things that are very hard to sort of capture in the LCOE. Mike, any last word from you before we call it a day?
Yeah, thanks for one last word. It's what you struck me, you said is something not exactly like that, pre-existing trends. What President Biden did with a lot of his renewable focus is added fuel to pre-existing trends. Everything's getting cheaper. We have to have 100% tariffs on BYD vehicles. It's going to put the rest of the automakers in the world out of business. It's just a better car, it's much cheaper. 3 times more efficient than my Chevy Bolt and half the cost. My Chevy Bolt's 11 years old. The key thing I want to point is what Trump's doing right now in fossil fuels. He's adding fuel to pre-existing trends. Crude oil is already going down. We have a glut of crude oil in this country. Natural gas, we have a glut of natural gas in this country. We have to export it. Grains, we have a glut of grains in this country. We have to export it. We have a strong dollar and a trade war going on. So I look at it as deflation's on its way. And every lesson of history points out when you have massive inflation, it always follows with deflation. China's getting it. Germany just downgraded again today to potentially flatten another year GDP. It's just a matter of time in the US. Everything for me in terms of prices depends on the US stock market and Bitcoin staying up. And the risks are they go down.
So my last words are, I'm optimistic. I think AI actually brings net positive. I think we as a country realize capital allocation is important, and miscapital allocation is very detrimental to this country. And I think that we'll be allocating capital a lot more. I have to throw out one more plug. I will have a webinar this Friday at synmax.com. You can find it's the Vulcan webinar. We'll talk about the build, the 62 gigawatts. Where is it going? How much is real? How much is not? So that's what's on discussion on Friday.
All right. I'll do one last marketing plug as well. We do these calls every Wednesday at 10 a.m. New York, 3 p.m. London. David, thank you so much for joining us in person. And next week, we also have some external guests. So we've got Jeff Osborne and John Miller from TD Cowen joining to chat about their perspective on the market. So please make sure you join us next week as well. And if you have any follow-up questions for David, just shoot me an email. I'm happy to connect you to him if you want to join his webinar on Friday or just be in touch with him generally. Take care, everyone.
All right.